Hi, I'm Lindsay Bennett, Healthcare Finance Executive. In today's video, I'm going to show you how to do break-even analysis in the healthcare industry. We're going to use some realistic examples in Excel, and we're going to calculate not only the break-even point in units, but also in dollars. And I'm also going to show you how this fits into the bigger picture of cost, volume, profit analysis. We're going to look at how costs behave as volume changes, at what point exactly we stop losing money, and then beyond that point, how much profit do we generate? Those are the types of questions that you're going to be able to answer at the end of this video. Here's what you need to know in order to calculate the break-even point. And I'm going to go through each of these and explain them using a realistic example in Excel. But first, you need to know the difference between fixed and variable costs. We're going to need to know our total fixed costs. We're going to need to calculate the contribution margin, which is the revenue per unit minus the variable costs per unit, and I'll show you how to get that number. And then we need to know the break-even formula, which is your total fixed costs in dollars divided by your contribution margin per unit, and that's going to give you your break-even number of units. So let's dive into this deeper. Fixed costs are the costs that stay the same every month, no matter whether you produce 0 units of something or 5,000 units of something. So if we're talking about imaging tests or primary care visits, whatever that unit is, the fixed costs always stay the same. And so those are things like rent for the building or insurance costs. Variable costs are the costs that increase every time that you produce one incremental unit more. So for example, if you are doing hip surgeries, the implant cost, you have a new cost for the implant every time you do a hip replacement procedure. So that's a variable cost. It's going to go up or down in relation to the number of procedures that you do. Okay, now we're going to walk through an example of calculating break even. And in this example, we are looking at a dialysis center. And you can see the screen looks like your typical income statement. You have a revenue section at the top, followed by an expense section, and the difference between the two is the profit or loss. So we have modeled this out here, and up in the revenue section, we have made some assumptions about the payer mix. So we have a certain number of treatments for Medicare patients. We have some commercial insurance patients and some Medicaid patients. So we have broken out the number of treatments based on the payer mix, and we put in some assumptions about the reimbursement that we're going to get from each of these payers. So if I multiply the treatment times the expected reimbursement, that gives me the revenue. So the $7,362,810 that you see here in total revenue, we're going to need that number to calculate the break even, because we need to get the revenue per unit, or in this case, the revenue per treatment. So if I take this $7.4 million and I divide it by the 23,400 treatments here, it's going to give me $314.65 per treatment. Next, below that, you see I have my variable costs here. And variable costs, remember, are those that go up and down as the number of treatments goes up or down. So the types of variable costs that we have here are the treatment supplies, pharmaceuticals, disposable supplies, and outsourced labs that we do per treatment. So we've made some cost assumptions here about each of these expenses and multiplied them times the number of units, and that gives me my variable cost. So this is another piece I need for break even. I'm going to take my $1,076,400 in total variable cost divided by 23,400 treatments, and that is going to give me a variable cost per treatment of $46. Now we have the two components that we need to calculate the contribution margin, because contribution margin, remember, is your revenue per unit minus your variable cost per unit. So I'll show you that in more detail down below, but that's what we just did. And now I'm scrolling down to the fixed costs. And you'll notice here that I've broken out my fixed costs between salaries and benefits and other fixed costs. And the reason that I did that is because salaries and benefits can be variable or they can be fixed. So for example, if we had a nurse that only came in when we had patients scheduled and did some treatments, and then she left and she wasn't there working a typical 8 to 5 workday, then that would be a variable cost. But if we have salaried people that are in the office, whether we have 0 patients or 500 patients, then those are fixed costs. So in this case, in this example, you can see we have whole numbers for our FTEs. An FTE is a full-time equivalent. That just means that they work your typical 40 hours a week. So because these aren't fractional numbers, because they're whole numbers, these are probably salaried people working a regular schedule. So you see them in the fixed section. And we've calculated out their salaries, and then we've added in another 22% of their salaries as benefits and payroll cost. Then if I look down below here, we have our other fixed costs. So things such as the facility rent, the utilities, the equipment depreciation, the hazardous waste disposal, billing, liability insurance, etc. And these are all fixed costs, meaning that it doesn't matter how many treatments we do, we are going to incur these costs regardless. And if I add up all my fixed costs, I get this $2,196,820 here. And this is the other number that I need to calculate my break-even point. So down here, you can see we've added up the variable and the fixed costs to get our total costs. And if we subtract our total costs from our revenue, that is what is going to give us our net operating income or loss. And in this case, it's positive, so that is operating income or profit. Now we can move down to our break-even section down here. And we've just carried down the total number of treatments here. And here's this $315 per treatment that we calculated earlier, taking the total revenue divided by the total number of treatments. That is a weighted average because you'll remember we had different reimbursement rates for different payers. So the mix of payers is not even. There are more of one payer than another payer, so it ends up being a weighted average. Then we have our variable cost per treatment, which is $46, which we calculated earlier by taking our total variable cost divided by our total number of treatments. And if I subtract that $46 from the $315 above it, that gives me $269 per treatment in contribution margin. The contribution margin is what is available each time we do a treatment to chip in towards paying the fixed cost. And that is up to the point that the fixed costs are paid off. Because remember, at some point, we don't have any fixed costs anymore. We've paid for them. They're not going to keep going up with volume because they're fixed. So beyond the point that we've paid off our fixed costs, that contribution margin per treatment is pure profit. So we have $269 left over each time we do a treatment to put towards our total fixed costs. So if I want to calculate break even, I take the dollar amount of fixed costs above, which is this $2,196,820, and I divide that by the contribution margin per unit, which is the $269. And the result is a break-even number of treatments of 8,177. That's how many treatments that we need in order for our total cost and total revenue to equal each other. Beyond that point, then we start earning profit. Now, what if I wanted to know how many patients that I needed to recruit in order to break even? Well, on this next line here, I can make some assumptions. So in this case, I've assumed that these patients are going to have 3 treatments a week and that they're going to come in every week during the year, 52 weeks a year. And if I take my break-even treatments, this 8,177, and I divide it by 3 times a week and then divide it by 52 weeks in a year, then I can approximate that I need about 52 patients to break even. And then I can calculate my break-even revenue if I want to. And the way that I do that is I take my total fixed cost, which again is this 2.2 million up here, and I need to divide it by the contribution margin percentage. What's the contribution margin percentage? That is easy to calculate because all you need to do is take the contribution margin per treatment, which is the 269, and divide it by the revenue per treatment, which is 315. So if I divide 269 by 315, it's going to give me 85.4%. So if I want to know my break-even revenue, all I have to do is take my 2.2 million in fixed costs and divide it by 0.854, or in other words, 85.4%. And that's going to tell me that I need $2,572,974 in revenue to break even. This graph is helpful for understanding how break even works. And if you take a look at it, you have two lines on here. We have our total revenue, which is this gray line right here. And then we have our total cost, which is our red line right here. And this is your fixed cost plus your variable cost equal your total cost. So what happens is early on when we're producing 0 units down here, we still have our fixed costs. So there's a cost associated with that. And as we are building up our revenue is below our cost line, which represents the loss. And then once we hit the point where our revenue is equal to our total cost, that is where we break even. And then beyond that, where our revenue exceeds our total cost is where we have profit. Now let's talk for a moment about cost volume profit analysis, or CVP analysis. You'll recall that in the spreadsheet we were just looking at, I have built a dynamic model. So if you go to the description, you'll be able to download that. What that means is that if we change any of the inputs, such as the volume, such as the cost assumptions, etc., all of that is going to flow through to the profit or loss line and to the break-even calculation. So what CVP analysis enables us to do is to model out and measure the changes in profit and loss, etc. If, for example, we have reimbursement changes. For example, let's say that our payer mix changes. How is that going to affect the break-even point? So one thing you can do with this model is, let's assume that it's going to take a while to contract with commercial insurance plans and get credentialed with them. We might take that piece of the model out and see what our new break-even point is and how that affects our operating income if we were to take out that piece. Also, we can model out our cost assumptions changing. So for example, what if these supplies end up being more expensive than we thought? We could give ourselves a percentage range of, error margin and see how that affects the final numbers. Also, what about if costs are restructured? So we could think about changing some costs from fixed costs to variable costs. So for example, the outsourced revenue cycle management, that might be a fixed monthly cost, or it might be a percentage of revenue, depending on how we structure our contract. So if we were to change that to a variable cost, how would that affect the break-even point and the profitability? What if the volume isn't what we expected? Well, we can model out aggressive scenarios and more conservative scenarios and see how that impacts profitability. Or we can model out several of these assumption changes all at the same time and capture that with the model. And that's what we do with cost volume profit analysis. As I mentioned, you can get the spreadsheet that we worked through in the description. And also, could you please take a moment to like and subscribe so that you get notifications when I put out a new video. And also in the description, you'll find a link to join my free mailing list where I will send you revenue cycle and healthcare finance training, free templates, slides, and calculators like the one you saw today, and also sign up information for my various online courses. Thanks and have a great day.